Hi everyone, good afternoon. Last time we were discussing about the portfolio classification. So I will go through these three portfolios. In fact, we discussed in length about this portfolio classification last time. So we have three types basically. Now I will brief you what we have discussed last time. So we have three basic types. Now we call them amortized cost. Then we have fair value through other comprehensive income, that is fair value through OCI, we call it in common, and the other one is fair value through profit or loss, right? So earlier these were now amortized cost were the one which we called held to maturity securities, held to maturity HTM, right? Then now with the IFRS or the SLFRS 9, the name has changed, but the concept is more or less the same. Like now we call it this with the intention only. This classification comes into effect. Now, when you purchase a security, you have some sort of intention of having it uh, till the till the maturity, or you have the intention of trading with that security, right? So that depending on that intention, you classify. So once you classify it, then it will be in that portfolio. So held to maturity securities purchased with the intent and ability to hold to final maturity. So those are the amortized cost ones, or the held to maturity securities. So you have the intent and ability to hold to final maturity, carried at historical cost on the balance sheet, but unrealized gains or losses have no impact on the income statement. Now there is no, we don't losses. Basically, we don't mark to market it. Mark to the market rates. The market rates will decide the price. No, market rates will decide the price. So according to its value, we don't do any adjustment due to the value change. So there's no impact on the income statement by amortized cost portfolio, right? Then we go into fair value through other comprehensive income. So this model qualifies for fair value through other comprehensive income is financial assets classified and measured at fair value through other comprehensive income. What is this? Are held in business model whose objective is achieved by both collecting contractual cash flows and selling financial assets. So this has two motives, like this has the motive of collecting contractual cash flows and also selling financial assets, right? So what is collecting contractual cash flows? Now earlier one, actually we were collecting contractual cash flows only, that is held to maturity. But here we have some sort of intention of selling this, but not really trading. Not really trading, right? But in a case you see an opportunity in the market, you can always sell this and uh, get the gain or the profit to the income statement. The other difference is we do mark to market this portfolio, fair value through other comprehensive income. Now earlier we used to call this available for sale. Available for sale is uh, sale is the same as this, right? So financial, now these classifications, time to time you have to understand, time to time we change the classification according to this accounting standards come into effect. So available for sale portfolio, or FVOCI, that is fair value through other comprehensive income, is subject to mark to market, right? Is subject to mark to market, and then we need to recognize the gain or the loss in other comprehensive income, that is in the balance sheet, OCI, right? So we need to recognize this in OCI, the mark to market gain or the loss. So and at the same time, we have the ability of selling this asset, right? But not really for trading purposes, right? Now we go to the other one, fair value through profit or loss. Other business models, any financial assets that are not held in one of the two business models mentioned above. That means if any financial assets fall into the category uh, uh, of uh, held to maturity and fair value through OCI, if you leave out them, then if there are other financial assets, right, which are not falling under HTM and AFS, will come into the trading portfolio. So trading portfolios, we call it held for trading, HFT. And now actually with the current classification, we call them fair value through profit or loss. So now what do you mean by this fair value? Always a fair value indicates that you need to market these portfolios. So how do you mark to market? What is meant by mark to market? Mark to market is you mark the correct value. You revalue the portfolio, right? You revalue the marking to market is you revalue the portfolio with the market interest rates, right? So that is it. So when you revalue the portfolio with the market interest rates, now we learned in our earlier lessons that this market rates has an impact on the price, no? That is our calculation, no? So the market rate is actually now depending on the policy rates and depending on other market conditions, the market rate can fluctuate. So that fluctuation we need to record in the case of fair value through OCI and fair value through profit and loss portfolios. So what happens here is we take these market rates and we revalue the portfolio. So market rate, when we revalue the portfolio with the market rates, now the portfolio, the revaluation will give new prices for this portfolio, no? Now new prices. So with the new prices, there will be a new value for the portfolio. There will be a new value for each and every security, and that will totaling up to the total value of the portfolio. So this new value, using the new market rates and our earlier value. So this can be a process every day, or this can be a process weekly, monthly, like that. But at least by monthly you need to do this, right? You can mark to market every day, but you need to pass entries at least by monthly, because you need to record you need to know your monthly profit or loss, right? And other incomes, right? So what happens here is then you get the difference of the earlier price and the new earlier value and the new value, right? So then you know whether it's a profit or a loss, right? If the prices have gone up, then it's a profit. If the prices have come down, then it's a loss, right? So so this now our classification is this
Mangala,
this
sorry to interrupt, Mangala.
Yeah,
Just some questions on behalf of the participants.
right.
Now, as and when you purchase the security,
As
you have
and
to,
when,
uh,
sorry,
as,
as and when,
as and when you purchase the security,
right.
the front office have to indicate whether it is meant to held to maturity or AFS or
Yes, correct.
HFT.
Yeah.
So at the time itself, there is
The
an
time itself,
understanding.
yeah, yeah. The time itself, they have to mention the securities destination. That is to which portfolio this security belongs. And in that portfolio only, the bank will be booking this asset,
Yes, yeah.
So
And
that is how it happens, yeah.
does the senior management like ALCO or some authority has to indicate for any portfolio to be categorized like held to
Yeah,
maturity?
yeah, it's like this now. When we have, we can. I mean, this classification is mandatory by these accounting rules, and also by the regulator. We need this classification, but the composition of the classification is entirely the institute's appetite of the portfolios. So
Yeah.
there should be an investment policy. Every organization will have an investment policy which will indicate what is the composition. That is, for an example, if I say like, okay, 40% of the uh, security should be in HTM or amortized cost portfolio, and maybe 25% in AFS and 25% in HFT, that is held for trading. So likewise, depending on the depending on the uh, depending on the appetite of the organization to have these portfolios, that is whether we are more concentrated on trading activities, and whether we think that it would generate profits for us, or whether we want to have a somewhat reserve kind of a policy where we go and land most of the securities in the HTM portfolio. So that means like maybe then someone can say, okay, 60% of the portfolio should be HTM, right? More reserve type, like, okay, you get the interest income and you live with that, like, and you have AFS, maybe 30% in AFS and 10% in trading. So that's another strategy. So this depends on the composition, depends on the strategy of the organization on these portfolios. Now we were actually talking about government securities, and government securities here, like treasury bills and bonds. But as I mentioned earlier, like, we can this applies to any debt uh, and equity portfolio. So any debt and equity portfolio should be, I mean, investment, any debt or equity investment should be categorized or classified under these three categories. That is there. But uh, but at the time of purchasing, you need to decide to what portfolio it goes. But later on, the transfers are allowed, right? But then subject to uh, different conditions, like, okay, we'll say, if the bank is in if the organization is in liquidity, facing a liquidity issue, then they will allow HTM also to be sold, right? But not for trading purposes, right? Not for trading purposes. So that,
Mangala, before coming to that, Mangala,
yeah,
now very often there is a limit structure,
yeah,
limit the categorizing to HTM, AFS,
yeah,
and HFT
yeah, yeah.
is governed by the limits that are given
Yes.
to the treasury, isn't it?
Yes, correct. Yeah, it's actually ALCO and the risk committees will join together, and then they will decide on the policy framework.
Yeah.
So then by that there will be limits. That is the composition of the portfolios.
Oh.
So
And then
then they,
transfer between the HTM and then HFT probably there
yeah,
is another policy where
correct. Yeah, there's another policy, and actually, if you do transfers, those transfers should be done at the market value. Done at the market value. So then any gain or losses should be taken into consideration. Like mostly the if there's now sometimes you just can't go and park, and HTM transfers are allowed only at exceptional cases, so that you can't do from HTM to the trading portfolio and trading to HTM very often. It's actually restricted. But then if you are facing a liquidity crisis situation, then anyway you have to seek your source of funds from those portfolios as well, no?
yeah,
So in a case like that only you can. But AFS, that is fair value through OCI, can be sold. Now the rule here is I have mentioned here, like now this is now if we take the for trading. Now, this is held primarily for sale in the short term, right? The purpose is to make a profit from market trades, movements by quick trade rather than the long-term investment. So, held for trading is that, and mark-to-market gain and loss will be recognized in P&L account. And actually, these transactions should take within 90 days. So this is a rule actually. So within 90 days, otherwise then they will inquire why did you purchase for trading portfolio, right? So likewise, there are certain things governing these portfolios under these accounting standards. Now we will go back here and we'll come back to this now. So here the categorization here is what they say is if a security cannot be categorized under the above two, that is HTM and AFS, then they will come to the fair value through P&L portfolio. That is how the categorization. But then mainly what is important here is when you buy a security, you have an intention. No, you have an intention whether to keep it till maturity, whether you want to have when you keep it till maturity, you will be collecting all the contractual cash flows. No, contractual cash flows are, now if we take a bond, the contractual cash flows are the coupons and the maturity value. No, contractual cash flows are the coupon and the maturity value, so you collect them. But at the same time, if you see some opportunity in the market, you can sell AFS. From the AFS you can sell, right? But not for trading purposes, right? You see a good opportunity, so you sell it. But one can argue, what do you mean by the opportunity? Like, so basically, that is why I showed you this trading portfolio. Anyway, it's meant for trading, right? So within 90 days you need to uh, complete the transaction. That is, if you buy within 90 days, there should be another sale, right? So what happens is, now if you think that there is no opportunity in the market, right? You will, time to time, these policies will change. I'm answering this first question still. What is the composition? How do we decide that? So the ALCO and the risk and all these committees will get together. All these people will get together who are part of this formation of these policies, and then they will decide. Now if there's no market opportunity for trading, then they will try to reduce their, they won't build up on their trading portfolio. They will have AFS and HTM, right? So Now, mainly the what is difference in AFS and STM? Sorry, AFS and trading. Now you know STM is anyway held for maturity, no. So you collect the contractual cash flows, and then you are happy with that. You keep it till the maturity, right? Unless there's a real need of selling it due to liquidity issue or something, right? You can't sell it for market opportunity when it is when they are at STM, right? When the securities are HTM, you see a market opportunity and then you can't sell, right? The market opportunities cannot be, grabbed by the HTM portfolio. But AFS and trading is there for that. But only problem is AFS is not meant for trading. But if you see a market opportunity, you can do trade, right? So that uh, two aspects are there. One is to collect the contractual cash flows. The second one is you see the market opportunities and trade. Uh, now, fair value through PNL, you don't have the have two aspects. One aspect only for trading, right? So that is why there's a restriction that within 90 days you need to do this trading. So there's no such intention of collecting contractual cash flows. So, and the other difference is now both these portfolios you need to mark to market. Both these portfolios you need to mark to market. But when you mark to market, this mark to market gain or loss will hit in the case of the AFS, the gain or loss will hit the balance sheet, right? But trading portfolio, what happens is uh, will get the hit on the PNL, right? The hit on the trading portfolio will be recorded in the PNL. So if you have a huge portfolio and if the market rates go up, right? If the market rates go up and you have a huge portfolio in the trading portfolio held for trading or fair value through profit or loss, as we call it now. So what will happen? You will be making mark to market losses, which will hit your bottom line. That is the PNL, right? So then your PNL will have uh, you know bad impact by this marking to market of the trading portfolio. But if you have the same portfolio in the AFS, right? So your PNL is there, nothing is nothing is changed. So you can publish your PNL nicely, but you get the hit on the balance sheet. So this will be charged in the other comprehensive income area, right, which will be deducted from the balance sheet reserves, right? So then your profit is although the income actually what you get is anyway the income or the like rather the loss will be the same, but you record it at different places. So in the case of AFS, it's in the balance sheet, and in the case of held for trading or trading portfolio, it's in the PNL. So if you don't want to get a hit uh, on your PNL, you can reduce your trading portfolio. So that should be formulated as a policy and approved by the board of directors. So board of directors will know what is our appetite on maintaining portfolios. So time to time, depending on the market conditions, right, you can change now. Like now, if you want, it's like this. You can now the apart from this classification, I had shown you earlier certain categorization of the investments. So we have bills, bonds, like that. Now if you think, okay, now if you think now the rate, now we will, if we talk about the current scenario, the current scenario, the interest rates are low, right? Interest rates are low, but then like you can't have them for long term, like long term in a HTM portfolio, and you can't have them in a trading portfolio as well, because if the interest rates go up, like they, you have to take the worst case scenario as well, no? So if they go up interest rates, then you will get a hit. So and if you if you have if you put your investment in long-term bonds, then even if you have them in HTM, right? Even if you have them in HTM, if the interest rates go up, what will happen? You will lose the opportunity. No, there will be an opportunity cost, right? Although you don't have to record it, there will be an opportunity cost. So to avoid that, you can change your entire portfolio. You can do little on bonds, and you can come to bills. Bills are short term instruments, and there's no such issue here. You can have bill HTM bill portfolio. So although HTM bill portfolio, the maximum would be 1 year, no? So in 1 year's time, all the bills will get matured. So so you the dealers can manage like that. The dealers can manage like that without going to. Now sometimes, like, you can say, you can select a different category, like shares or some other instrument. But now in present scenario, you don't have to do that. You have another instrument, which will give you the exact solution for what you want. So there are so many ways you can manage this. So, but only thing, the composition should be formulated, and get the board of director approval, and then you can implement that. So time to time it can change also. Hope the my explanation is clear. If you have any other questions on that, please ask, because this is a very interesting and good area to
One more question, Mangala.
Yeah, sure, Mr. Natnaik. Yeah.
Now, for the ILF facility, you have to allocate some securities.
Yeah.
So mainly, whatever there is under HTM, you give it to allocate it.
Yeah. That is you can give, like, then now you can have in the ILF. Now very, now some banks, they don't have in the ILF account every day, but some they can, like we discussed earlier, some can keep in the ILF, and in the morning they can request, no. So in that sense, Mr. Ratnayaka, like it can be from the HTM, no issue. So then it will be easier, no? Because then you don't have to worry about that, because anyway they are not meant for trading, no. So
Yes.
if you keep it from the trading, then if you need to trade them, you have to get back, no.
Yeah.
If you need the ILF every day, like, or every day, or if you want to keep for an emergency, some keep the securities in the ILF account, then you can request in the morning, no. So so that way HTM securities can be transferred there.
Okay. Thank you.
Right. Thank you, Mr. Ratnayaka, for the questions. So now fair value through profit. Now we discuss this now, and we will go to this processes. Now this actually the same thing. This is in a this diagram form what I have already explained. So now this how the contractual cash flows and solely principal and interest like that. So you ultimately arrive at amortized cost, fair value through profit or loss, and fair value through other comprehensive income. Right? Don't worry much on this. I just took it from the CA Sri Lanka site. Actually, they have explained this well about this categorization. So if you really want to know more about IFRS SLFRS 9, then you can visit this site csrilanka.com. They will have all these details there, right? So we discussed this earlier, but we will go through again. STM, held to maturity securities are purchased to be owned until maturity. Investor in a bond will plan to hold the same to maturity. Investor in a bond will plan to, that is, if you buy a bond, you will hold it till maturity. Accounting treatments for HTM securities compared to securities that are held for uh, trading and available for sale. So accounting treatment is the the differentiation here, right? Uh, and then held to maturity securities provide investor with the consistent stream of income, but will not provide short term gains which could be obtained by trading. So this is the main thing. So consistent stream of income means this is the contractual cash flows, but will not provide any short term gains. That is why I said in the STM portfolio you can't seize a market opportunity. Like if you see a market opportunity, if you have this if you have only the STM portfolio, we will say, right, you have 100% STM, and if you see a market opportunity, then what can you do? You can't do anything. Only thing is, if you sell, it's a violation. So if you sell, if you can sell, I mean, it's your portfolio. No one will no. There's no system, restriction for that. But if you sell them, then it's a violation of the uh, requirements, right? So there will be repercussions on that. Usually they will ban you from having such a security, such a portfolio for, I think it's for 3 years, right? Once it happened some time back, one bank actually, they wanted to get the opportunity of this thing and of the market, and they sold the entire HTM portfolio. So then after that, it was prohibited for them to have a HTM portfolio for 3 years. I think the regulator had some sort of impose some sort of penalty in the sense they were restricted from having a held to maturity portfolio for 3 years. But although like it's a violation, they gained out of that. So those are the repercussions actually. So and this is not subject to mark to market. You know what is mark to market now? Mark to market is revaluing your portfolio to the market yields. So that is then eventually it will be the market price. You will be calculating market price and you will get the total value of the portfolio, right? So so not subject to market, but some organizations, they can have for their own interest, you just can mark to market it and see, but there's no like use of it, right? You can just see, but because why I say no use, because you keep it till maturity. Then when you keep it till maturity, irrespective of the market market movements, you will be anyway getting the face value. No, you will be anyway getting the face value. And if you mark to market, and if you see a huge income on that, or rather appreciation of value on STM, you still can't do anything because you are prohibited to sell from STM for to grab the market opportunities. Only in a situation where uh, you have a real liquidity issue, you can make use of this to generate liquidity. So that should be with the approval of the board, and maybe you have to get the consent of your auditors as well. So that is a long process. Actually, you can't do that overnight, right? So we go again to available for sale. I have put both names in uh, in these slides, both names, because then it is easier, because you should know, like now these names are the earlier ones, HTM, available for sale, and held for trading are more commonly used ones, right? So later only, like held to maturity became amortized cost, and available for sale became fair value through OCI, and held for trading became fair value through PNL. But same scenario, but time to time, now accounting standards change, and uh, and then you have to adhere to them. So available for CL securities are debt or equity securities purchased with the intent of selling before they reach maturity. So it can be with that intent, but there's no hard and fast rule that you have to keep them. You have to sell them before the maturity, but that intention is anyway there. But they have the intention of, as I earlier mentioned, uh, taking the contractual cash flows as well. So, and as earlier mentioned, unrealized gains and losses are included in accumulated other comprehensive income, right? In Within the equity section of the balance sheet. So equity section, we will have the reserves and all these things. So if this is a loss, it will be reduced from your equity section, right? So now trading, held for trading, uh, will be the mark to market gain or loss will be recognized in profit and loss. And we went through this slide earlier. Held primarily for sale in the short term. The purpose is to make a profit from the market, profit from market rates movements, and quick trade rather than the long term investment. No investment intention is there in this long term investment intention. And you need to sell within 90 days of the purchase, right? If you can't do, then there should be a procedure where you need to get board approval and all these things, but then the middle office will point out, because you can't have long-term investment for long-term investment in held for trading. Then that is why it is very important at the time of purchase. Now you should have the dealer should have a proper understanding of the future market movements, as well as the potential changes in the market. So that is the judgment at the time of the investment, or rather, sorry, at the time of the trade, right? At the time of the trade. So you decide whether they should go to HTM, whether they should go to AFS or the trading, right? So it depends on the market interest rate, the other factors which are affecting the prices. So stability of the currency, like that. So those factors you take into consideration, and if you see quick gains in the market in future, you can purchase for held for trading or fair value through PNL. And if you think that there's no short term opportunity in the market, you can decide on AFS or HTM, right? So likewise, it's a decision and the intention at the time of purchase. So now I have just mentioned some income. Now since we were discussing about the income, so income from different portfolios, I just have mentioned here interest income. Now debt instruments will give interest income, capital gains. Debt instruments are actually the bonds, bills, like that, the debt instruments. That is, the issuer is indebted to the investor or the buyer, right, or the holder. So those are debt instruments. And equity instruments, you get dividends as income. You get dividends, and there will be rights issues, bonus issues, split issues, like that. Those will also generate income for you. Now these will give you more shares, and then more shares will have more value sometimes. So that more value will give you income, right? So these are the income generated from portfolios. Income, different types of income. So these different types of income we record in our PNL in under different categories. Interest income category, capital gains, uh, gains category. And in fact, I have missed one point here. So we can discuss about that. Now in the case of equity instruments, you can have capital gains as well, right? uh, Sorry for the omission. But equity instruments, you can have capital gains as well. So if you have already printed this, you can add this equity instruments. So these are the income types you get from this instrument. So that's it about the categorization of or classification of portfolios. To summarize this, uh, uh, I will go through these three categories again. Like now we have three different classifications for any portfolio. Any debt or equity portfolio should be categorized in three categories. That is the category in which you have securities held till maturity, right? That we call amortized cost portfolio or held to maturity portfolio. So same, both names are for the same, right? Then the next one, we have the intention of keeping it till a long time, but not sometimes until maturity. But we have the intention of getting the contractual cash flows as well, and also seize any market opportunity. Sell and get the sell and get the capital gain, right? So that category is called uh, fair value through OCI or available for sale. So that is the second one. The third classification is held for trading, right? That is, you buy and sell and gain out of buying and selling of securities. So short term basis, you don't have any intention of getting getting dividends, or getting the interest income, the contractual cash flows in case of debt instruments, dividends in case of equity instruments. Like that, you don't have, your intention is to trade them very fast and gain out of it. So this category is classification is called fair value through PNL and or held for trading, right? Both names are used for this. This will bring us to the end of this section, that is portfolio segmentation. So if you have any question on this, you can ask now. Otherwise, we can go to the next area, right?
Mangala, better go to the next area because we have only half an hour more. Eh?
Yeah, that's the thing. Yeah, we will touch. Yeah, we have only half an hour. Yeah. So we will go to our next slide show. Now, this is very important area. A certificate course on money brokering will cover this possible malpractices as well, right? Why it is important for this certificate course? Because then the brokers, this is for the brokers of the brokers can, avoid such situations if they feel that the dealers are you know into some sort of malpractice. So that is one of the important thing uh, for you all to learn this, right? How this will come, what would be the symptoms, right? So first of all, we'll just go by some, some sort of uh, uh, this definition about malpractice. It says improper, illegal, or negligent professional behavior. Right? You have a professional behavior now, so there's a code of conduct and professional behavior. So, but it is out of it now, like improper, illegal, or negligent professional behavior. So, and any behavior by which a dealer or a broker intends to gain a dishonest benefit or a deal with the counterparty or in an investment. So you can't now. There are market norms, ethics, and also rules and regulations covering our market, right? Governing our market actually. In fact, so these are if you take these, we can classify them into three broad areas. We can say international and local standards. We can say the regulations by the various authorities, like we can say the central bank, the Colombo Stock Exchange, Securities Commission, like that, and the law of the country. So now all these professionals are are expected to adhere to all these. But if you have an improper, illegal, or negligent professional behavior, or you have an intention of to get a dishonest benefit, right? That unfair benefit, right, which others will not have, then it's a malpractice, right? So you can see whether these opportunities they are for the other participants as well, right? If not, right? If not, your analytical framework is a different one. But if you get some information or something which is not available for other participants, then it's a malpractice. So you can differentiate what is a good practice and what is a malpractice, right? So we have gone through this area, and we have uh, categorized about seven malpractice symptoms, right? Symptoms of risk approach. Now in this approach there are some symptoms, to for a person to see or judge that there is a malpractice happening. So we will quickly go through this. Dealing at off market rates, number one. Number two is dealing with one or two counterparties regularly. Now you have a concentration risk. That is, you deal only with two or three counterparties or one or two counterparties. Dealing with not so commonly accepted counterparty, right? Dealing through accounts of relatives and friends. So that means dealing for your own account. Like, so since you can't have your own account, dealing right? Or you bring them to the dealing this thing and dealing uh, scope, and then you right, okay, deal, but you deal on behalf of them, like not actually they are involved in this. An exchange of valuable gifts. So gifts, exchanging of valuable gifts by brokers to dealers, dealers to brokers, and other counterparties. So that is also a symptoms. Now we don't say these are actually really malpractice will happen, but these are symptoms. These, if you see these things regularly, then that means something can go wrong. I mean, something will happen which is not a good practice, right? Acquiring of high value assets. If someone is acquiring a very high value assets, beyond that person's income, so then there can be it can be a symptom of a malpractice, right? And frequent discussions using code words, right? So when these discussions you have which cannot be understood, which cannot be understood by other people, is also uh, a symptom of malpractice, because you don't want others to understand this, right? So this can be understood by you and the other person, or the dealer and the broker, or two parties involved in this, right? So that is also that leads, or rather uh, those are coming from malpractices. So you don't want others to listen that or understand that, right? Okay, we will go to one by one. Off market rates, using rates on trade transactions which are beyond the rate prevailing and the range for the day or the period. So this, now we can't say a deal has to happen at this particular rate. So then there is no market, no. So the market movements are there. Market movements are there. But when looking at the market rates, like, okay, now the middle office will do this job. In fact, they will go through the days plus the days high and low, and see whether, like, whether this out of range rate is justifiable, right? Out of rate range is justifiable, right? It can be swap transactions, on repo transactions, and then what will happen? This will facilitate the gain or the profit to go and park somewhere, right? Say, suppose if I sell a bond, right? If I sell a bond well above the market price, and other person will sell, right? Other person will sell. So I will have the profit now today, and the other person will suffer. But this will be a mutually agreed one later on. This can happen both ways. It's a pattern, like you get the gain today, then I get the gain tomorrow, like that. Out of range rates, and sometimes they are very close to the day's range as well. So you don't change it by maybe 2-3 rupees, right? It can be, okay, 50 cents, like that. But careful analysis would reveal that these are not the real rates that we should use. These are out of range. So off market rates are those kind of rates which can be used for park the gain somewhere, some end, right? The two parties are involved, no? So those will be parked at someone's books, and it can happen vice versa, like it can come here and go back, like that. And dealers also, the traders also, the brokers also will try to earn undue profit out of that, right? This is illegal profit out of it, right? So then we go to dealing with one or two counterparties regularly. So if you find that regularly dealers are dealing with one or two counterparties, very regular transactions. For a day, you get maybe 6-7 sales and purchases for small margins, and dealing with same counterparties, and sometimes you find that they have unusual friendships, right? Uh, Unusual friendships to with these. So that is also a matter to be concerned. So these will be actually captured by the systems, right? These will be captured by the systems, and to control them, there will be counterparty limits. There will be counterparty limits. So the middle office will observe whether these counterparty limits are being adhered to, right? Whether these now limits can be exceeded, right? Limits can be exceeded because limits are there, but depending on the requirement, sometimes with the approval and with the consent of the relevant people who can approve this kind of a thing. Okay, now if the policy governing limits is there, and the policy is subject to ALCO's Assess and Liability Committee approval, or the Risk Committee approval, or something like that, then they will seek the approval to sometimes breach the limits depending on the market opportunities that they have to seize. So that is there. But then if you see, always the traders are uh, exceeding limits with, you know not all, with one or two counterparties. All the time they break the rules for them, right? So that is a suspicious thing that needs, anyway, that middle office will check all these things, so that can be a symptom of a malpractice. Then the next point is dealing with not so commonly accepted counterparties. So accepted counterparties are there. No, now some counterparties are there who are not very commonly accepted. Now, when you say commonly accepted, everyone likes to deal with the uh, parties who who have very strong financial backing. That is, they should be financially very stable, no, for you to deal with. So mostly, like anyone would not like. Okay, all the systems are there to protect you. Like as I said, we discussed earlier, these settlement systems have these simultaneous settlements of funds and the securities, so that you don't expose yourself selves to the risks of not settling. But although those things are there, everyone, right, every trader would like to have the counterparty, a very stable counterparty on the other side, right? So but very rarely only the people will think, okay, no, I mean, like, we have to help the other counterparties. There are ways, no, they can raise money, because this we are in financial markets. So they need to, if they want to deal, so they need to raise money somehow, and then they have to start using their existing uh, you know existing resources, or they can build upon those resources. But if someone is very very frequently trading with these not so commonly accepted counterparties, then that means there's some sort of likely of the trader to be on the malpractice side, right? Uh, Trader to be on the malpractice side. So now they will select uh, some counterparties with weak monitoring systems, right? And the counterparties with weak risk management capabilities, and counterparties with greater risk appetite. So these kind of people, they will try to select and try to, now they don't have, they have a greater risk appetite. They don't have these monitoring systems, risk management. Maybe they don't have enough cash flows even. So that type of an counterparty would, welcome the traders in different ways. So then these can lead to malpractices, because then it is sometimes win-win situation for both parties, right? But it's a malpractice, and the market will get suffer, because market will not have the transparency. We will discuss them later on, the advantages and disadvantages, right? We'll go to the next point, dealing through accounts of relatives and friends. We can't deal on our own account. There are restrictions, and the code of conduct is there. So you can't have your own account dealing. But then what they will do is they will have discrete accounts maintained with licensed commercial banks and primary dealers in the names of relatives and friends, right? So then those accounts will be used to, you know, capture the swindle the part of profits and commissions. That is, capture the, the gains. So you do transactions with them with using these accounts, and no one would think that it's you only operating this. The trader is the person who is operating this, but the outsiders will see someone else's name there, right? So unless they disclose it, this is a friend of mine or a relative, sometimes not very not very very distance. Now they will use very sometimes very distant relatives also, right? Then no one would see the similarities in the the surname or anything like that, right? No one would know that it's a relative and friend. But if you get to know that these transactions, sometimes these will be like in the earlier case, will be well above their capacity to trade, right? But dealer is doing huge deals without any hesitation. Sometimes they, now if another person comes with that capacity, dealer won't dealer won't be won't be dealing with them even. Like they will say, okay, no, like we can't, like you need to have this this type of strong financial background for to do all these types of deals. So this is also another way, like people try to get the undue profits out of the financial markets, right? Then exchange of valuable gifts, the gift exchange is happening, right? Now, if you take the reality during these festival seasons, New Year, Christmas, this exchange of gifts happen. But there should be a limit. Like, okay, sometimes you celebrate your achievements with exchanging of gifts, and sometimes it can be a cake or something like that, right? But those should be declared always, right? Now there shouldn't be a secret, right? Secret gifts, and sometimes you see them not very secret, but there should be a policy, internal policy, which should prohibit accepting such gifts, right? So they will say, now I have seen some policies in banks, they will say you can't accept anything, any gift, a cake or anything, right? Which is more than rupees, maybe 1,000 rupees, right? Like that, very small, small value is allowed. Otherwise, if you have to, if you get anything, you have to you have to uh, you have to inform the management, or you have to tell, like, okay, or you can refuse, right? So you can't, this should be, or not could be, actually it should be covered by internal policy. Actually, most of the places we have an internal policy covering this exchange of gifts, right? So people cannot use this method to this is what will happen. You initially, you send gifts, and then they are compelled to deal, right? They are compelled to maybe dance to your tune, right? So likewise, this is a very gray area, right? In the sense, like, how we control this, right? Internal policy should be there and strictly adhered to avoid this type of malpractices coming in through this, rather, to avoid malpractices coming through this exchange of valuable gifts, right? And then acquiring of high value assets. Now, in the banks, like, and any financial organization will, look at their, will monitor their people, whether these people are live beyond their means, right? That means you have a salary, and they have some fair idea what assets you have, right? So if you live beyond that, then that means it there will be a, you know there will be some sort of unknown income source uh, is available for this person, right? So there will be a noticeable change of behavior, lifestyle, right? These are the symptoms. May try to help assist colleagues, office mates. So that, some people try to help, right? Help, and they will, bring all these, things, like, sometimes they host everyday breakfast, every day, every day. Just give me a minute. Just a minute. 1 minute, right? Hello.
You may also be able to contribute if you have additional points to the what is being spoken now, because it's a day-to-day practice, and then you have also seen a couple of events, incidents in market. So therefore, please think and contribute if you can.
Sorry for the interruption. Now, so acquiring of high value assets. Now, this actually, you can see, like, now we see sometimes, and now we had, different organizations. We had some examples where people, start living uh, very, lavish lifestyles, and then later on found that there were malpractices like that. There had been, a lot of examples in international and locally, uh, how these people have, because when you do something and when you get money, it's very difficult to hide, right? You tend to, spend them on various things, so it comes out, like, so this is also a good symptom to, monitor, right? And frequent discussions using code words. We actually discuss this code words, like, the people, they don't want others to understand this, and they will, share this information secretly, using market information, using secret codes, and use of unauthorized communication methods. Now, there are actually permitted methods of communicating with people, right? And those methods are actually recorded. Now, if it is a call, there will be a call recording. Likewise, the unauthorized communication methods, very frequently, if they do deals with these using these communication methods, actually the TM or the Treasury Middle Office will, have an eye on this. So this is also another, symptom of a malpractice malpractice can be like can happen, right? So and there are some other areas of concern, and mainly I would like to discuss about the insider dealing. Now, this insider dealing is actually you deal with unpublished material information, unpublished material information of a security or any other asset, right? This information will be obtained by illegally and unethically. And when the information is available in the market, dealer realizes the profit. Now, how do you obtain this? Because you get friendly with someone, inside person of the company, right? Then you get all the information. It can be the profit, it can be acquiring of some other, company, and then you now, for an example, if we take like we say we want to buy some company shares. Now if we are dealing with company shares, right? If the profits are high this time, now this company, before the disclosure comes to the, or before they inform this to the Colombo Stock Exchange, you get hold of a person inside the finance department of this company, and get the information and you deal, right? You buy shares, and then when the when they declare the profits in the stock exchange, then the share price will go up. So then you sell and realizes the profit. So this is called insider dealing. Insider dealing, actually, the definition is dealing with unpublished material information. Unpublished means not published. Material means this is material for the price movement, right? So we go to the disadvantages of these malpractices to the person, company, and the community. The So financial penalties will be there personally and on the company. There can be jail sentences as well personally, and the directors also will get sometimes jail sentences. Damages to reputation. So personally, company wise and the community wise, your reputation will uh, at a stake, will get damaged. So these are the malpractices. So you should never go get into these kind of thing, right? So you don't see sometimes when there's people, now in history, like we have, if we have taken people who has gone, who has done malpractices and gone to jail, and got financial penalties. They would not realize these when they were, when they start doing. But we have to, beforehand, we should be very conscious about these things, right? And apart from all the ethical stance, right? And also this will not happen, affect you personally and the company wise, the industry as a whole, and to the economy, right? Will have a huge impact, right? There's no economic value, right? Because for a fraud or a malpractice, there's no there's no value created to the company, and not even to the economy, right? And it doesn't assist price discovery. Now, price discovery is a area where the demand and supply for this instrument will come into play. But now when you do a malpractice, there won't be a price discovery, because you manipulate the price by your malpractice. And no, do not add to the liquidity, right? Because these are actually not creating any liquidity in the market, right? They are just facilitating certain fraudulent transactions, right? And unjust enrichment by one or few individuals without adding social standards. Now when you know this, the wealth creation will uplift your social standards. Now what we do, when we say market is good, So the market will should create wealth, right? Should create wealth. So to create wealth, it should properly function, right? But when you go and add these malpractices in the market, it will give wealth to some few people, the unjust enrichment, right? Unjust, that is, you can't justify what you get, right? Because you are actually doing a fraud. So social standards and the loss of market confidence or the loss of market integrity. People will lose confidence in the market because they don't see any price discovery, no liquidity. They will come to know about these malpractices. Then there will not be any confidence and the market will lose its integrity, right? So these are the disadvantages, right? These are the bad side. Bad in the sense the malpractice itself bad, right? So these are the repercussions, rather than disadvantages of that, the repercussions, right? And now, if you check the regulations, now there's a very recent 2019 regulation by Market Conduct and Practices for Treasury Operations of licensed banks in Sri Lanka, number 6 of 2019, dated 29th August 2019. We are planning to cover this fully, depending on the time available in your next semester. So this will cover the policy framework, ethics and standards of conduct, general dealing principles, risk management principles, professionalism and knowledge level, declarations, and sanctions on non-compliance. So now under this 7 headings, there will be lot of things. Uh, there are a lot of things covering all these, most of these malpractices, all these malpractices, right? So they will have framework and they will have standards and conduct. So code of conduct will come under this. So this is the regulatory requirement. So if you now we were talking about in general the repercussions of malpractices to the person, the company, and the society, right? And also to the economy, right? And to the industry. But those are actually those are not the rules, no. I mean, people would say, okay, what nonsense, you can, who bothers whether whether our company benefits or not, right? That is bad. But people can think like that, but to the regulator covered all these here, right? So there will be a code of conduct you will be signing. So these regulations plus the law of the country will, you know you will uh, control this, uh, control happening of all these malpractices, will be controlled by the this regulation as well as the other laws in the country. But it is a very important regulation. If you can read through this, it will be very helpful for you to enhance your knowledge. So this will end my session on the malpractices, the market conduct and
I
practices.
want to add one point, Mangala.
Yeah.
Now, in the banking industry, there is a process called whistleblowers.
Yes. Yeah.
Whistleblowers. Now,
Yeah.
under the customer charter regulation issued by the
Correct.
Bank Supervision Department of Central Bank of Sri Lanka,
Yeah.
each and every banking institution should have a whistleblower policy.
Yes.
And then under that policy, there should
Yes.
be a complaint resolution officer in each
Yes.
bank in the
Yes.
higher command category.
Correct.
And, and then anyone from the lowest grade up to the senior grades,
Yes.
anyone observing any symptom that Mangala was explaining all this time, they are able to confidentially or publicly or whatever, through email or to telephone or SMS or text messages, inform the compliance supervision officer such observances.
Right.
And then one condition is that it should not be malicious reporting against anyone, but reporting in good faith to protect the institution, to protect the economy, to protect the company, and then to generally protect the market.
Correct.
If all that can be proved, the whistleblowers are taken seriously, and under the policy, such whistleblowers cannot be penalized or punished by any means for merely reporting an observation. So therefore, what I suggest is even for the money broker community, with the blessing of the central bank or amongst the under the auspices of the money brokers association, you must introduce such policies.
Correct.
So that when you observe something illegal happening, you can report to an authority who could investigate,
Right.
or to the management and put that right.
Yes, correct.
And only thing, it should not be under with any malice.
Yeah.
It should be very positively reported with a good intention of bringing good reputation to the industry, good reputation to the company, and good reputation to the individuals as well.
Correct. Yeah. Yeah, that's a good point actually. Then only thing without malice you have to do it. Because most of the people are bit reluctant in some cases of whistleblowing, because they have to disclose themselves in certain stages of that. So then whether these things will come against them, so that there should be some sort of regulation and laws to protect them as well, in my point of view. Should be there, like maybe otherwise sometimes they will the messenger will get killed, you see. Like so that we need to protect the messenger. So by strengthening the framework, regulatory and legal framework, so that has to be there. So then it will be really a useful thing to curtail these kind of malpractices. Thanks, Mr. Ratnaik, for your knowledge sharing on this. So we will call it a day, right? Any questions? Yeah, right.
I must also thank Mr. Mangala Karunaratne for his invaluable inputs to the course. Today is going to be his last presentation, but if time permits, later on we'll invite him for more sessions. But on behalf of all the participants and the Money Brokers Association, let me express my gratitude to Mr. Mangala Karunaratne. Thank you.
Thank you, Mr. Ratnagar. Thanks for inviting me for this course again after, we have been working together for a long time. And, it was really interesting to working with money brokers as well. Like I got to know a lot of, industry people by, doing this course in early occasions. Since we have restrictions now, I can't see everyone's face like and to interact with you, but earlier sessions were more interesting to recall. Like they were we were having a lot of interactive learning. So maybe we can improve on, because we are also new to this and all are new to the online teaching and learning process. So hope
under the online conducting of classes, there's more depth into the subject matter.
Correct. Yeah, that is there, because we actually we put a lot of time on preparing these slides, because we know, like we don't use a board, and we don't have much opportunity for interacting. So lot of information is embedded in the slides actually than those days. So sometimes, although the slides are crowded now, we learned the good old days. We learned that slide should be with one or two words and others other stuff should be explained. But now we have changed a little bit more. Even in my banking classes, I have put a lot of slides, lot of information on slides because it can later be referred by the participants. And also, so I thank all the participants for your, very committed participation and, making me also comfortable by, by having, we had a few, casual chats in between, right? And I apologize for the interruption sometimes because 4:30 is office hour for me. But since I didn't want to, keep you waiting till maybe 5 to 6:30, like, so I accepted Mr. Ratnayaka's invitation. So thanks everyone. I thank IBSL as well for accommodating me for all these years for these courses, right? This is the first one. Tell you some to share some personal, information. Taking a few, maybe 2 minutes. I stopped lecturing last December due to I went through a bypass surgery. So this your course is the first one I started as a start. I did because I was thinking of giving up also because I not because of the surgery because after the surgery I had 3 months holiday at home, so it was really a good time because I didn't have to do anything, just watching TV. And I got what addicted to this free time, like watching TV films and all this. So that sometimes gave me the idea of quitting the lecturing and enjoy the free time. But Mr. Ratnayaka dragged me again into this by I since he is my I really respect him, so I never let down any request made by him. So but anyway, it was good actually. It was good, Mr. Ratnayaka. I again thank you very much for this. So I started banking class also 2 weeks ago. So thank you very much.
Saying that how can the market and the community let a person like you with that such a vast knowledge to idle at home? I
Yeah,
don't think
thank
it
you
is.
very humbly accept what you say. So thank you so much, Mr. Ratnayaka, for guiding me also all this time. Like he guided me for this lecturing, outside the bank lecturing at IBSL. So that is long time ago.
Yeah.
So it's nice meeting you all, everyone. We will meet when these things all the time, like maybe even after 1 year, like pandemic won't be there forever, like, right? So we can meet physically as well. Hope that I will be able to come for the, like, or rather we will be able to have a physical maybe
Interaction.
certificate awarding ceremony, like we
Yes,
did last
yes,
times. So
yeah.
that's the hope. Okay, thanks very much. Have a nice
Thank
week,
you, Mangala.
nice evening, and also nice future ahead, right?
Thank you, Mangala, for all your support and effort.
Thank you.
Thank you. So, good evening, everyone. Tomorrow will be the presentation by Mr. Chandika Linage on market ethics, the point of view of the Money Brokers Association. So, please come prepared for that. And then I want more participation from each and every participant tomorrow, please. Thank you. Good night.
Good night, sir.
Good
Thank you,
night.
sir. Good night.
Thank you.
Thank you, sir.
Thank you, sir.
Thanks, sir.
Thank you,
Good
sir.
night.
Good night.
See you, Mr. Ratnayake. Thank you.
See you. Thank you, Mangala. Thank you.
Menaka. Thank you.